What is your take on the latest NFP numbers? Now, you would probably say, if you look at the headline numbers, you will say it's mixed. I mean, the NFP was weaker than expected, quite weaker than expected, but the unemployment rate was also better than expected. So this is a mixed NFP report, isn't it? Well, not quite, and I'm going to explain you why. See, first of all, as I always say, we need to go deeper than the headline. There's more to the single NFP number and the unemployment rate. In this case, in particular, there's the revisions to pay attention to. Now, let me open up the full BLS report. If we scroll down all the way to the bottom, you're gonna see something very interesting here. Now, the change in total non-farm payroll employment for May, so the previous NFP, was revised down by 66,000, from 129K down to 63, which means essentially that the NFP of May, the one which was released in June, it was not 129K, but it was 63. The BLS is just saying, hey, we were wrong in the number. This is the more accurate number right now. And the change for June was also revised down by 37K, so from 57K down to 20K. Now, this was the previous NFP, which was in fact 57K. It's now actually 20K. So again, wrong number. This is the more accurate number. If you add up all of these revisions, you'll see that the combined, they're lower of about 103K, lower than previously reported. In other words, 103K workers that were never there in the first place. Now sit with that for a second. 3 FOMC members, participants, voted for a hike at the previous FOMC meeting. They wanted to hike interest rate, and they wanted to because they saw a certain type of labor market and a certain type of inflation. Now, that labor market that they saw at the previous FOMC meeting, and the reason why they actually voted for a hike was actually not there. Now, obviously, most of the reason why they voted for a hike was inflation, but it was the combination of inflation and labor market, because as you know, the central bank looks at that, inflation and labor market. Now, on the labor market side, we're seeing that things are actually much different than we actually thought, than most thought. Now, we saw the weakening of the labor market already happening in the previous NFP, which also saw the previous 2 NFP also revised. Now, if you looked at the video that we made after the NFP, explaining in fact why we're bearish for the dollar, expecting the Federal Reserve to not hike for that reason. But essentially, we're seeing the same setup once again. The NFP was overstated, and they're now being revised lower by a total of 103. Now, with all this said, now you might be thinking, well, what about the unemployment rate? Isn't that actually better than expected? Okay, let me explain, because it goes much deeper than you think. Now, if we look at the unemployment rate itself, so the headline unemployment rate, yes, we saw that it actually ticked lower. It was expected 4.2, it actually ticked lower to 4.1%. Now, I know what happened in your head the first time you saw it, and you think, well, weak NFP, strong unemployment, it's a mixed number. It's a mixed NFP report, but it's not. There are 2 ways in which the unemployment can go down. First reason is simply that people get hired. Obviously, this is the good one. This is the good reason why the unemployment rate can go lower. The second reason is that people exit the labor force. Well, this is the bad one. In other words, this is the bad reason why the unemployment rate can go lower as well and still be negative. Okay? Now, the latest drop, this drop in unemployment rate from 4.2% to 4.1% was exactly because of number 2. If we look at the participation rate, which simply tells us the number of people actually into the labor force looking for a job. Now, this participation rate actually fell, meaning people are exiting the labor force. So the unemployment rate did not fall because the economy is hot or because the labor market is hot. The unemployment rate fell because people exited the labor force. Now, this is not a good reason for the unemployment rate to be low. This is not a sign of strength in the labor market. Now, again, the labor market here is not collapsing. I'm not one of those ones calling for a recession or whatever. No, I'm just saying, hey, things are actually less hot, less good than what they actually appear on the surface, because despite the fact that the unemployment rate is actually falling, well, under the surface, things are actually falling for the wrong reason, which is the lower participation rate. So with this, we're already establishing an important context for why the dollar should weaken further and why the Federal Reserve actually shouldn't hike interest rates. But let's go step by step here, because it doesn't stop just at this. The next point that completes the picture for this labor market report that we got is wages. If you understand what central banks look at, and if you have been watching our educational videos about how to read central banks and so on and so forth, which if you want, you're gonna actually find it right now on the top right. But essentially, if you understand a little bit how we read a central bank and how you should read a central bank as well, you understand that wages are part of inflation. And if wages are hot, then the central bank can become worried about higher inflation, higher structural inflation, because when wages are hot, there's the risk of a wage spiral. And that's what the central bank is most scared about. So essentially, it's a spiral where workers demand more wages, firms raise prices, inflation gets sticky, and it becomes a loop, a self-sustaining loop within the economy. So it's not an external shock, as instead is an energy-driven issue like oil spiking, but it becomes a domestic structural issue that needs to be addressed. But if we look at wages right now, well, 3.2% versus 3.5% is expected, well below previous as well. Wages are not hot. Wages are not cause of concern for the Federal Reserve. They're falling, so there's no wage spiral. And this removes to the hawks that may want for the Federal Reserve to hike, well, it removes another argument for them to hike. First of all, they don't have a strong labor market as much as they would want it to be in order to hike. And second, now they don't also have the fear of a wage spiral. Now, all of this, which I've just said, is dovish. It's dovish for the Federal Reserve. The Federal Reserve, so far, with everything I've just laid you right in front of you, with the labor market we have right now, is dovish. Doesn't call for a rate hike at all. And this is, obviously, no surprise, bearish for the dollar. Okay? Now the question, which brings us to the main point, is actually the August 12, July CPI. Now, okay, we have established that the labor market does not justify the hike. Then the entire case for a September hike from the Federal Reserve, which is the scenario that would strengthen the dollar. If the Fed were to hike in September, the dollar will strengthen. If they don't hike, the dollar will weaken. And as you see, this is fundamental analysis. We're establishing the scenarios here. We're establishing that hike, yes, equals dollar strength. And obviously, the contrary is hike, no, equals dollar weakness. Fundamental analysis in trading, it's about this. It's about understanding the scenarios. It's about understanding the paths ahead. Because now, understanding whether the Fed is going to hike or the Fed is not going to hike tells us where the dollar is going to move forward. Okay? This is fundamental analysis. It's establishing the scenarios and the path ahead. Because by understanding what the central bank looks at, and I repeat this over and over because this is the essence of it, by understanding that the central bank looks at the labor market and looks at inflation, by understanding this, we understand what the central bank then is most likely going to do next. Because if inflation does a certain thing and the labor market does a certain thing, they may or they may not need to hike accordingly. So all this said, we've established the context for the labor market. Now let's see a core inflation, because core inflation, which is scheduled to release on Wednesday, is already expected to come lower from 2.6% to to 2.5%. And as you see, as you know, I'm focusing on core CPI. Obviously, headline CPI, it's gonna matter, but not as much as core CPI does, okay? Central bank focuses on core, and that's what you should also focus on if you want to extrapolate how the data moves the market and how the Federal Reserve is going to move next, so that you can actually know whether they're going to hike, whether they're not going to hike, so that you can actually know how the dollar is going to move, okay? Now, if the consensus here is right, and if in fact core CPI drops from 2.6% to 2.5%, well, that's already quite a good progress, because core inflation was at 2.9% just 2 months ago. So 2.5% is way closer now to the 2.2% target that the Federal Reserve has. So let me summarize here the picture, okay? If core CPI does in fact print at 2.5% core CPI as economists expect, then we have inflation still cooling. We have also established that we have wages cooling. We have a negative NFP. We have labor participation falling. We have also revisions, large revisions, I would add, to prior to NFPs. Everything that I've just talked to you about in this video, wages cooling, that's a fact. NFP negative with revisions to the two prior NFP, that's a fact. Labor market participation falling, that's a fact. The missing point now is inflation. We gotta understand and confirm that inflation actually falls to 2.5%. That's what will unlock way more dollar weakness, if it does in fact print 2.5%. Because right now, if we look at the CME Watch tool, we see that we have still 44% chance of a rate hike in September. And if core CPI prints at 2.5% as the economists expect, then 44% is still too high. It should be closer to 20%. And if you understand the correlation between interest rate expectations and the currency, you know that if expectation for an interest rate hike fade, so move lower, then the currency weakens. In this case, the dollar would weaken. So just keep in mind, obviously, the other side of everything I've just laid out to you is that the core CPI may come in hot. It may come at 2.7%, but we're picturing the probabilities here. We're picturing, first of all, the scenarios, and we're seeing that things are lining up step by step, point by point, for dollar weakness. Now, except this one point, which we're gonna have to confirm next week. Now, if you follow us on our public Telegram channel, you will see that we're actually already short the dollar by being long the pound against the dollar. If you follow us on a private network, you'll know exactly the entries for this trade. But yes, that's the point. I lean towards this picture completing. So 2.5% core CPI, we're gonna see next week. And if it confirms, then that will eventually lead to the Federal Reserve to not hike in September. Now, obviously, there's another labor market report at the start of September. There's another CPI report before the September FOMC meeting happens, but the market moves in advance, okay? If we're gonna see softish core CPI, well, the market is going to move in advance, pricing out that interest rate hike from September and weakening the dollar. Okay, so if you like this type of analysis, let me know with a comment down below and a like on the video.